Good afternoon, ladies and gentlemen. Great, by the way, to be able to present in person again after 2.5 years of travel restrictions in Western Australia. So it's good to be finally in a plane again. So what I'm going to talk about is really the mega trends, the big picture trends that affect metals and mining private equity as an investment class. Those of you who regularly attend this conference will have heard all my speeches about how mining private equity works in practice prior to COVID. So this time we're going to do something different. We're going to talk about really what are the big issues affecting mining private equity as an asset class. That will help you to kind of better understand how we think about the world and is hopefully helpful to those of you who are capital seekers. So the trends that I want to talk about is to what degree do any of these trajectories inform how we think about investments, the energy transition, we're in a prolonged equity bull market, ESG, cost inflation, supply chain issues, how metals and mining private equity as an asset class is performing, and then about risk. So let's start in the first one as an energy transition. Obviously, I'm not going to go in a lot of detail here because there's a lot of more detailed presentations what the energy transition means for metals and mining. But suffice to say that it's actually a very strong secular trend and a generational paradigm shift. So what we're going to show here is just one simple slide about copper. So over the next 20 years, 18 years to be precise, you'll need 8 new US containers to satisfy the copper demand. As a result of energy transition alone, which means electrification of vehicle, charging infrastructure, renewable energy. And if you include the other demand drivers as well, like electrification of new buildings, et cetera, then you actually need 13 new US containers over the next 18 years. You compare that to permanently declining grades, as you see on the right-hand side of the slide, and the fact that the last time that a significant copper discovery has been made on this planet was Kamoa exactly 14 years ago. So we certainly can't see where all these additional metals and minerals are going to come from. Now, that is a great story from the demand side. That's a great story from a price projection point of view, but there's a flip side to this. So before I discuss what the flip side is to this, let me just characterize how we as investors behave. We are long-term investors. So our money goes into the development of new mines, into the de-risking of new mines. So we are long-term capital. So we have to think 3, 4, 5, 6, 7, 8 years ahead. We're not equity promoters who basically plant seed equity, and when the equity story works out well, can trade out shares into liquid markets. So we don't have the ability to do that. So what happens with our money means the business has to happen in the real world. And when you have to think about the things in the real world, you also have to think how the market's going to look like over the next 6 to 8 years and what the risk is. The reason why I mentioned that in the context of the energy transition is because very high prices permanently in the future you can't have. Because what that would mean in reality is that electric vehicles are not going to be cost competitive with the internal combustion engine. What that might mean is that actually renewable energy will not be rolled out in the same manner as people forecast today. So that means that one cannot use permanently high price levels as you see today as a go-forward assumption to the future. So when we underwrite new investments, I'm not saying you use the last 10 years average prices, but you probably have to use something that's materially lower than the prices that you see today. And a lot of people who come to us with investment propositions are quite surprised by that because they say, hey, just look at how much copper is required. Just look at how much nickel is required. I'm saying, yes, that's true. But if you have the current high prices forever, the electric vehicle costs twice as much. And this therefore no longer be. The other thing is, again, you look, for example, at lithium here, 1,400% annual new demand required if you believe the forecast. So that's not going to happen. So again, when we look at these markets, we have to take a relatively conservative view because what it means when, for example, automotive manufacturers or battery manufacturers look at these charts, they will say, okay, there needs to be an alternative. So what it means, there's a lot of money going into innovation and into substitution. So when we underwrite, we are going to use prices. We have to use prices that are actually much lower than the prices that you have out there today. The other danger with such an overwhelming demand picture is there's a very strong incentive to actually bring a lot of mines into production that have pretty high execution risk, like difficult metallurgy, difficult ground conditions. And when you build a mine that's difficult and it doesn't work out, then it doesn't work out, and then the money is lost, even if the prices are high at the moment. So again, we will take a very realistic, and it's not just we as Denham Capital, but all the mining private equity firms have to take a pretty kind of technically realistic view on the underlying execution risk, what it actually takes to bring actually a new mine into production. So then we have been a prolonged equity bull market. So people ask us regularly, well, what does that mean for private equity? I mean, conventional wisdom is actually when the equity valuations are very high, that's not good for private equity. Well, that's not exactly true. Well, first of all, it makes it easier for us to sell the companies and monetize the companies that we already own. But it also means that the project pipeline gets replenished. If you look at the chart at the left-hand side, you actually see that until recently, actually capital raising in the mining industry was in an 8-year high. And that's actually a good thing for us because as investors who are very focused on asset quality, we actually started to get worried that there's actually not that many good projects left anymore. That are worth investing into. So it's actually a very welcome thing that you actually have a lot of new capital actually flowing into exploration. Now, having said this, when you look at the chart at the right-hand side, that actually shows what all the new capital that the mining industry raised over the last 3 years, what this capital has actually been spent on. The single largest element of that slice of that pie chart is actually general and corporate overhead. So that's actually quite surprising. We certainly would hope that much more capital is actually spent on developing new mines and on exploration, which is interestingly enough only kind of a minor capital application within all the equity raised. Nevertheless, much more money goes into exploration than over the last decade, and that's a good thing. Now, what is a potential negative, or what should give a little bit pause for thought, is at what level the equity valuations are today. What you see on the left-hand side is a PNF multiple chart, percentage of net asset value. That's the common valuation methodology in metals and mining. And what this chart actually shows, and this is base metals producers and base metals developers, is that the market today, by and large, values development risk at the same multiple as only 2.5 years ago producing risk. So the market essentially says, hey, it's become less risky to build a mine over the last 2.5 years. Well, that's obviously not the case. So we believe actually there's a lot of cases today where the public market misprices the execution risk. The real risk, what it actually takes to actually develop a mine roughly on time and on production, on time and on budget. So what does it all mean for us? It means that there will be a lot of cases because, as I've said before, we are financing the development of mines into production. So that's a very significant risk to assume. There will be many cases out in the market where the equity valuation that the companies are trading as is just too high. So we would not be willing, and not just we, us as a firm, but the other mining private equity firms as well, we would not be willing to kind of invest at those high valuations. But that does not mean that we cannot provide the capital that's required to develop these mines. What we then typically try to do is to find a structured solution, like via preferred equity or subordinated debt, or a combination of those. So if the equity valuation is too high for us to come in, then we work together with management teams and with companies to find another solution. And typically that's preferred equity or subordinated debt. By the way, because everybody's so focused today on battery metals, on energy transition metals, some of the best opportunities out there are often quite of those metals are minerals that are actually widely ignored by the current markets, like certain industrial metals and metallurgical coal, actually. We've done actually quite a few deals in that space recently, and they've all worked out pretty well. ESG is another major trend that's affecting us. Now, first of all, I shall say for responsible mining companies and responsible mining operators, ESG is not a new thing. ESG is a new word, but it's been called social operating license in the past, and it's still called as such today. So for anybody who is a responsible mining operator, what is called ESG today is actually nothing new. The thing that is new today is that you actually have to go through quite a lot of formal processes to show that you comply with all sorts of criteria. We have to do that as a fund as well. We have our ESG reporting, et cetera, et cetera. But in reality, on project level, on the ground, things are being done as in the past, because I said before, the mining industry can only live when it has a positive social operating license. So from that respect, is actually just putting a formal framework around things that responsible mining operators anyway have been doing. Now, obviously, by and large, ESG is a positive thing, but there's also some unintended negative consequences that we as investors got to think about quite carefully. The first one is we come across a lot of other fellow investors who say, well, ESG means that you can't invest into metals and mining, period. We've encountered that quite frequently. And that requires a lot of education, because that is crazy, because that actually means that you actually cannot mine the raw materials that are actually necessary to make the energy transition happen. So obviously everybody has a lot of job to do here to actually educate the investment community, and on that we include our own investors as well, right? That actually without mining there's no energy transition. There's still a very large percentage of the capital community that actually doesn't understand that. Now, in more detail and in more nuance on the when you utter the word coal today, like literally 98% of capital providers leave the room. With metallurgical coal, it's a little bit better, but not much. We've just gone through the process of financing our metallurgical coal project in Australia. I have to tell you, that was a difficult process. And it is because there's absolutely, for ESG reasons, very limited willingness to discuss, for example, that metallurgical coal is needed for renewable energy. So if there's no metallurgical coal, there are no towers for wind turbines, there are no solar panels, right? So that is just something that is very, very difficult to discuss on a rational basis with a significant portion of the financing community. The other one is there is genuinely something like low CO2 coal and high CO2 coal. And the fastest way for steel mills to actually get, for blast furnaces to get the CO2 footprint down, is actually to use more low CO2 coal in the blast furnace and throw certain PCI and semi-soft coals out of the blast furnace. So one of the unintended consequences of ESG is actually almost complete capital withdrawal from actually those types of metallurgical coals that would actually help the steel industry reduce the CO2 footprint. Another one is the gold mining industry. Again, when we have to take decisions about whether to finance gold mines or not, we have also to take a view how are ESG trends going to affect gold mining, for example, several years going forward. We know, for example, that some very large public market investors have commissioned technical studies about the CO2 intensity per ounce of gold. With a few, just like people plot cost curves, to actually plot CO2 curves, with the potential objective to actually condemn at least the other half, the higher 50% of CO2 per ounce of gold emitters. So these are all things that we have to think about very carefully as we deploy capital with a 6, 7, 8 year forward view. So supply chain, cost inflation, all these trends, they go hand in hand. They're inseparably together. So the good news is, once you're in production already, metals and mining is actually a great hedge against inflation, because as inflation hits the world, cost curves are going to shift to the right, and actually inflation itself actually helps underpin higher prices. That is a great thing, and that's positive. Now, however, when you're building a mine, then one has to be very, very careful again what you're underwriting. And again, we are living and breathing that, because as we are speaking, several mines are being built with our capital. Because when your feasibility study, for example, is a year old, right? In the current inflationary environment, it might be economic history. So it may have to be repriced, because at the moment you have an environment when the contracts are not locked in, the capex is going to go up almost 10% every single month at the moment. So therefore, the only feasibility studies that are really bankable are really very, very recent ones. Otherwise, they have to be redone or repriced. When we due diligence budgets of people who come to us seeking development capital, we take a very, very careful view and say, okay, how much risk sharing is there between the capital, the company, and the contractors? What price risks are the contractors willing to eat? Are they willing to eat the steel price risk? Are they willing to eat fuel? Are they willing to eat real labor? Because each of these components have the possibility in the current environment to go up 20, 30, 40% during the build phase of the mine itself. So you got to think about safety buffers. Is the conventional 15% contingency in the budget enough, or do you need 30% in the current market just because of cost inflation? So these are the things that we have to think about when people come to us and seek development capital for a mine from us. So then mining private equity. We regularly read in the newspaper that mining private equity is going to expand as an asset class. We are not so sure that's actually true. We actually think that the capital in the room today is roughly the amount of capital that's going to stay there going forward. And the reason is because, as you see here on the left-hand side, obviously no names, please. There's been a relatively kind of, shall I say, unclear performance amongst the various metals and mining private equity firms. I mean, it's no secret there are some that have actually quite malperformed. So going forward, what we actually expect that there's going to be some mining private equity firms that are going to prosper and they're going to grow in size. And there's going to be some other ones that are going to disappear altogether, or going forward only going to raise much smaller funds. So when it's all done and dusted, we believe that the capital in the room today, the deployable AUM in the mining industry is give or take approximately $6 billion, right? In our assessment. Now, that is not a lot of money for an industry that is metals and mining, which is essentially a $2 trillion industry, right? On a revenue basis, and actually also happens on a market cap basis. So for this huge industry, you only have $6 billion mining private equity in the room. That's not a lot. That asset base, in our opinion, is not going to grow because of the very kind of, shall I say, diversified performance of the firms. On the right-hand side, you can actually, by the way, see what happened to oil and gas private equity in the US. Within a period of just 3.5 years, it's gone down from $90 billion to $22 billion deployable AUM for ESG reasons. Now, that might actually be good news for mining private equity, because some of that money that's been withdrawn from oil and gas might actually find its way into metals and mining. But the reason why I show this slide is because there's this common belief that metals and mining private equity is going to grow hugely as an asset class. In our opinion, it's not. In our opinion, the capital is in the room today. That's it, what's going to be for quite a while to come. Geopolitical risk, the Russia-Ukraine conflict is just a recent example, but one always has to think again, for us on a go-forward view for 6, 7, 8 years, one always has to think a little bit about the unthinkable. And one of the things that one has to think about is, how much can investment cases be, for example, in today's world, be reliant on China? As commodity investors, we all want a constructive economic and political relationship between Western democracies and China, but one cannot take this for granted, unfortunately. So when people come to us, for example, the only offtake partners are Chinese, or for example, the Chinese companies have preemption rights on certain things, that is something that might not work for us. And that is just because one has to diversify the political risk exposure. Coming from working in Australia, where we have seen essentially a trade embargo by China on everything in Australia except for iron ore, right? One has to think about the things very carefully. So, for example, when people, for example, build a bauxite mine in Australia, the bauxite's targeting the seaborne market, and the only off-takers in the seaborne bauxite market are China. Is that a valid investment proposition? It might not be. Because with the snip of a finger, China might say, well, we're not going to buy bauxite from Australia anymore. So this is just, long story short, we just have to think kind of very carefully about the risks. And while there's a lot of euphoria at the moment of battery metals, it cannot translate into reckless or overly optimistic underwriting. We still kind of have to think very carefully about the world. At the end, maybe just a few examples of what we're actually just doing. This is not an exhaustive list of what we're doing. Just a few examples. We own almost 100% at the moment on Cerro Verde. That is the world's largest single known heavy earth mine that's being developed in Brazil at the moment. We've been developing this through peak COVID in Brazil. That was also not easy. So that's going to come into production in the next year. Pembroke, Australia's third largest metallurgical coal reserves that we own. We're just financing the development of that. Construction has started. Wished we'd have it in production today at the current prices, the more than $1 billion dividends. Through our African platform, Pangaea, we own, amongst other things, almost 60% of Alphamin, a TSX-listed company. It's the world's highest grade tin mine, a little bit more than 4%, 4% reserve grade. That's pretty good. That's roughly the equivalent of a 16% head grade copper deposit. So that was under our input, and with our CEO, who we brought into the business, brought into production on time and on budget. And also very recently, it's actually our most recent deal, we actually acquired a significant equity stake in a company called Incor, which is a calcium carbonate producer in the Dominican Republic with processing in the US. So the types of deals that we do, everything from outright acquisitions of producing assets, earnings, to control stakes, to significant minority stakes, preferred equity. So we are pretty flexible. What's more important for us than the underlying commodity and the deal structure is that the asset is really good, has scale, has real quality, and that the management actually knows what they're doing. So that is actually what really matters to us, the people and the assets. So I quickly pause here if there's any questions. Please.
Very interesting. I noticed you've got a big investment in DRC. How much does logistics play in your decision making for a landlocked country, for example?
Yeah. First of all, we don't want to have to build large logistics systems. It's very capital intensive, right? So we wouldn't be the ones who want to build like long railways and things like that, or ports. That's not us, right? In the DRC specifically, are the logistics easy? No, but they are feasible, right? So for example, even during COVID, we never missed a single shipment. Unbelievably so. We got the trucks with the tin through the port in Mombasa, through several country borders, from the DRC into Rwanda, from Rwanda into Tanzania, from Tanzania into Kenya, with not a single week delay or otherwise disruption. What they did is just you basically swap the drivers on the border, you disinfect the cabins, and you got another crew taking over. So to avoid the quarantine. We had a bridge collapse that caused us a little bit of a delay, so we had to rebuild that. So that was flooding related. It's not as difficult as it sounds. It would be more difficult if we were a bulk mineral operation. We wouldn't want to have a bulk mineral operation in that part of the world. But tin is pretty high value good, so you're actually dealing with relatively limited volumes.
Have the Chinese got a stranglehold on processing lithium from that hemisphere, please?
I have to say I'm not a lithium specialist, but certainly, building lithium hydroxide plants, they've been mostly built in China, so far, like rare separation plants, like electrolytic manganese plants. I mean, that's one of the reasons why a lot of these battery minerals have much higher execution risk than, say, conventional copper, right? Because you have to think about a pretty sophisticated downstream component. There's, for example, only one electrolytic manganese plant in the world outside China. And that's in South Africa, right? And you have dozens of companies running around, for example, trying to commercialize electrolytic manganese. And not a single management team running these companies really know what they're doing, because nobody's done it outside China. So you have the same thing. You have the same thing in lithium as well. There's lots of lithium deposits out there that are being quite successfully commercialized on the equity markets, but they are just too small, right? You need a lithium deposit of real scale to justify kind of building a hydroxide plant, right? So when you get if you don't have at least 200,000-300,000 tons input into the hydroxide plant, right? You just don't have sufficient scale. But the public market doesn't understand that. So at the moment you just have the right lithium on your office door, and you already have some market cap.
Thank you.
Any other questions? Or if not, find me afterwards at the coffee bar.
But I just had a question just from this morning's panel around the energy transition, and just wanted to get your view on whether you thought that it was going to be coming as quickly, perhaps as the rest of the panelists. I know you weren't here actually, but they seem to believe that the higher prices in coal and the hydrocarbon binge that is going on currently is actually going to accelerate the move to battery and electrified transportation systems, etc., and accelerate the energy transition. Do you subscribe to that, or do you think
I don't have a crystal ball? But what I can tell you is if the prices of a lot of battery metals are staying the way they are, they're equally an obstacle. I mean, the lithium carbonate price is $60,000 per ton, right? That's far too high. I mean, you have the current price levels of all the kind of metals that are required for the energy transition are themselves an obstacle. Not to mention the fact that in some of these metals there just is no established raw materials base out there. Period. Again, coming back to the copper slide, that by the way already assumes that recycling will double, So that's already factored into all of that, which a lot of people tell me is not going to happen realistically for metallurgical and logistical reasons. Again, Camorra discovered 14 years ago, and you need 13 new Escondidas. Escondida is almost 3 times as large as Camorra in the next 18 years. Like, no idea where that's going to come from. Like, no idea.
Okay.
So am I correct in hearing you say that it's one thing having the metal, having manganese, having nickel, having copper, having lithium, but turning it into a battery usable metal is a whole different ball game?
For some of these metals, for some of them it is, For manganese it is, absolutely. For lithium it is. For earth elements it is,
Nickel?
For graphite is nickel is a special case, right? Because what you have now is the leathery nickel made out of Indonesia that's going to hit the market, and Tsingshan, I mean, were the ones that have successfully commercialized laterite nickel for the ferronickel industry and have therefore put a price ceiling on nickel on ferronickel, and that price ceiling's gone down significantly, So the same people that have de facto invented laterite nickel for the ferronickel market versus nickel pig iron are now the ones that have started shipping from Indonesia battery nickel made out of laterite nickel. So if that catches on, the until recently propagated wisdom they can only produce battery nickel out of sulfate nickel might actually turn out, kind of not true. And if you can actually produce battery nickel out of laterite nickel, then I would argue there's actually not going to be potentially a shortage of nickel, because there's actually truckloads of laterite nickel in the part of the world where I'm living.
Thank you.
But China certainly at the moment has a head start on commercializing battery nickel out of laterite nickel.
Okay, thanks very much, Bert.